What's up, you guys? Do you have options? I know we do. We're going to go ahead and make sure that you have some too when dealing with the stock market.
So, what if you could control 100 shares for a fraction of the price? Today, we're going to get into what is an option, how do they work, and strategies you can use.
All right. So, what is an option? A financial contract that gives you the right, not the obligation, to buy or sell a stock at a set price within a certain time. The two main types of options are calls and puts. Call, buy while the market is going up, and then for puts, you buy a put and while the market is going down.
Okay, so back to what we're getting into, the two types of options is the call option, which is the right to buy at a set price, and then a put option, which is the right to sell at a set price. For example, you buy a call, you're betting for the stock to go up. You get a put, you're betting for the stock to go down.
Exactly. So key terms for options: strike price, price set in the contract. Okay, the price is already set as soon as you click on the contract to buy. The expiration date, last day to exercise the option, and then premium is how much the option is going to cost you. And then the contract size is 100 shares per contract.
So why do we use options? We use options for leverage. To control more shares with less money. Everybody wants to do that. That just sounds like the best thing to do. You can control more shares with a less amount of money. As long as it's done right, you're going to profit. Then you're hedging. Hedging is protect your investments. We have a way of protecting investments, which is called risk tolerance. We'll get into that later. And then income is generating premiums from selling options.
Yeah, so risk of options. Yes, you can lose the premium. The premium is how much you bought the option for. Time decay works against you, and that is called theta. You'll be able to see theta at the bottom of your contract, along with the rest of the Greek signs. The next one is requires market knowledge and actual risk control. And as long as you have the knowledge and you have risk control, then those won't be an issue for you. But definitely, you got to know what you're doing inside the stock market.
Okay, so the common strategies is buying calls, which is bullish, buying puts, which we call bearish, cover calls, which is income from stocks that you already own, and protective puts, which is insurance for your stocks.
Okay, great. So buying calls, which is bullish. Expect stock price to go up. Low cost, high side. For example, you want to buy a call, let's say on Apple. Apple for $235 for the strike price, and it expires in 30 days. That's just an example of what buying a call would look like. You would look at the chart and say, hey, it looks like they're about to go up. I think 235 will be a good strike price, and let's set it, 30 days out.
So buying puts, what we call bearish, is you expect the stock price to drop. Yeah, you can profit in the downward market. Everybody needs to know that because people think that you can't profit, but you can profit in a downward market. For example, buy a put on Tesla at strike price is $300, expires in 45 days. That's what a put contract will look like. You say, hey, it's going down. Look like it's about to hit that $300 mark. If you set it to expire in 45 days and get your money. But play it safe.
Yes, and make sure when it actually hits the area or the number that you call that you actually get out. Oh, all right. So cover call income. So you sell a call on a stock you already own. Earn premium, but may have to sell shares if price rises above the strike.
Okay, protective put hedging. So you buy a put to protect the stock that you already own. It's like insurance. You limit the loss, but cost a premium. So it limits you don't lose as much money, but it's going to cost you a premium to do it.
Exactly. Next we have is risk versus reward table. So here's the strategy. Some of the strategies that we talked about, and then we'll talk about the risk, the reward, and then what is this what is it best for? Like, what is the market doing at the time? To buy a call for the first strategy, the risk is the premium you paid. So whatever you paid, if you paid $100 for the contract, $200, or if you bought multiple contracts, you have thousands of dollars in the market, then that is what you risk. Your reward is unlimited. Okay, that's they mean that it is absolutely unlimited. And then that's best for a bullish market. For buying puts, it is the premium you paid again for the risk. Large if stock falls, okay? And then this is best for bearish markets. Covered calls, missing upside is the risk. Premium income is the reward. So as soon as you actually sell the contract, they automatically give you a premium. So that's one thing I absolutely do love about selling options, is that you do get a premium. And then income plus mild bullish is where it's best to go ahead and do this type of strategy. And then protective puts, you have the risk is the premium paid, the reward is limited loss, and then this is best for long range holding.
All right. So for the final tip for beginners, you got to start small. Please start small. Don't put all your money in the market. You don't want to do that. Use as less money as possible and work your way up. Next, you want to understand the Greeks, the deltas, the thetas, the vegas, the gammas. We'll get into that later. But if you want to get into contracts, like if you try to you want to get into learn about options before you get into us, make sure you look at your Greeks and know what they mean. That is the main thing to buying options, what these Greeks mean to your contract. Next, you want to avoid trading just before earnings unless you understand volatility. When earnings are around, unless you know what you're doing, leave it alone. I don't care what you see go up or whatever, because those contracts have what we call implied volatility in it. So it might look good, but once you get into it, it's going to be harder to get your money because that volatility is going to hit you.
Exactly.
And then next, always risk money you can afford to lose. If you can't afford to lose it, leave it alone. Don't even get into it. It's a bad habit. You don't want to start bad habits. You want to start good habits when you get into the stock market. Starting bad habits will mean you'll lose more money.
Yes, most definitely. So this is for our advanced traders. Please, beginner traders, if you would like to sit in and listen, just so you know in general what do some advanced option plays look like. It will be for these next 5 screens. All right, so number 1 is income and low risk premium capture. So for the first one is iron condor. When you sell an out of the money call spread and put spread at the same time, profits if price stays in the range that you set it for. Then we have credit spreads. Sell an option closer to the current price and buy one further away to limit the risk. And then the last one is covered strangle, where you own a stock, sell an out the money call and an out the money put to generate extra income.
All right. So 2 volatile plays is number 2 volatile plays is straddles, which you buy a call and a put at the same strike expiration. Profit if price moves big either direction. Strangle, which is similar to straddle, but strikes are different. Usually cheaper, but needs bigger movement. So a calendar spread is a short term is a sell short term option. You buy long term option at the same strike. Profit from the time decay. And diagonal spread, which is a calendar spread but with different strikes.
Yes. All right. Next is directional but hedge. So we have a bull call spread. Buy a call at one strike, sell a higher strike call to offset the cost. The next one is bear put spread. Buy a put and sell a lower strike put to reduce the cost. A ratio call right, which is sell more calls than the stock owned for extra income. but riskier than a cover call.
So hedging and protection. So collar, own stock, buy a protective put, sell a cover call to finance the play. Synthetic long, synthetic short. Use options to mimic stock ownership without buying the stock. Protective collar with debt spread limits both upside and downside, usually for preserving gains.
Yes. And then for the last one, it is high leverage complex plays. So you have the butterfly spread, where you have three strike strategies that profit when stock lands near a target price. We have the broken wing butterfly, adjusted butterfly with one wing further out to reduce loss potential. And then you have the iron butterfly, sell a straddle and buy the wings, like the iron condor, but with more narrow ranges.
So, pro tips for the viewers. Advanced advanced doesn't always mean more profitable. They often require precise price targets or volatile expirations, have more moving parts to manage, and are better suited for experienced traders who understand the Greeks and risk management. And that is the stock market right there. It's contracts. You got to understand the Greeks. You got to understand your risk management, or don't get into options. That is the bulk of the options right there.
Exactly. So smart trading tips. So make sure you guys use indicators or chart formations as confirmations, not just predictions saying, "Oh, I think it's about to crash," or "I think it's about to go up." I need you guys to actually use your indicators and really look at the chart and really try to study it. Stick to 2 or 3 favorite strategies. Do not overwhelm yourself. And then make sure you keep a journal, track your entries, your exits, and your whys. If you do not have one, then we have a journal link below that you can go ahead and click on so you can get yourself a trading journal. And then make sure you guys practice on a paper trading platform like Webull, TradingView, and or Robinhood.
Please paper trade first.
Yes, yes. So please make sure you like and subscribe.
Like and subscribe. Then tell us at the bottom, like in the chat, which option strategies do you use the most? Like, let us know.
And which ones do you hate the most?
Yeah, we would love to know that. So maybe we can get into a couple of those segments.
Oh yeah, most definitely. And then join our Patreon/Discord for weekly chart reviews, early access, daily updates, and just so we can let you know what's going on inside the market, and we can help you with the best strategies to utilize to make sure that you are a profitable trader.